Last October, I was celebrated by Monevis for receiving the biggest payout they've ever paid, $35,000. The best part was that I made most of that payout, a little over $26,000 in a single forex trade on the British pound. The trade actually generated a lot more than 26k because I copied it on some of my other prop accounts like VST, FTMO and Fintokai. At the end, it totaled $150,000 in profit. But that's not even the mind-blowing part. Would you believe me if I told you it needed little to no analysis on my part? It was mainly a supply and demand trade. In this video, I want to discuss my go-to strategy to come up with winner trades depending on other winner trades, a chain reaction of profit, and how I used only supply and demand to seal the deal on these trades. By the way, this is the same strategy I used to pass multiple trading challenges at the same time. I think you might have guessed it by now. This video is all about market correlation. I want to show you how simple it is to execute correlated trades. We'll dive deep into the Forex correlation matrix, my trading rules, and I will discuss in detail the supply and demand rules I used to make it happen. Do you remember the Euro-USD trade that moved me on FTMO's leaderboard from the 10th to the 3rd rank? Well, this Euro trade is the reason why the British pound trade was very successful. Like I said, a chain reaction of profits. So in reality, I did little to no fundamental analysis on the British pound. All I needed to do was A, my supply and demand analysis, and B, I needed to take a quick glance at the correlation matrix. Let me begin with the matrix, and we'll do the supply and demand practical lesson at the end of the video. The correlation matrix. We see it all the time in data analysis and finance. Simply put, it's a table that displays the relationship between multiple data sets. One moves, so does the other. And in trading, it's the same story. Let's look at the correlations between the 7 Forex majors. We have 7 columns: Euro, British pound, yen, franc, Canadian dollar, Aussie dollar, and the New Zealand dollar. The same goes for the rows. 7 rows with the exact same pair. So the first takeaway the correlation matrix has to be square. Okay, how can we read it? There are 2 ways we can show correlations in a matrix. Either by giving the values a range from -100 to +100, like in the table right here. And imagine a percentage symbol next to each one. Or from -1 to +1. You just need to multiply by 100 in the second scenario. Alright, what do we have here? We have the correlation coefficient, which are the values between -100 and +100. And they represent the strength and direction between 2 instruments. So a value of +100 represents a perfect positive correlation. Both of these instruments move in the same direction. And the value of -100 is a perfect negative correlation. Both instruments move in the opposite direction. And the value of 0 represents no correlation, which means these 2 instruments move independently from each other. For example, in this matrix, the Australian dollar and New Zealand dollar have a correlation of +98. That's an almost perfect positive correlation, meaning they tend to move in the same direction with very strong similarity. Canadian dollar and euro have a negative correlation of -81. This is a significant inverse relationship. So when one of them move in one direction, the other move in the opposite direction. British pound and the Swiss franc have a correlation of -57. So it's kind of a negative correlation, but not a strong one. It's right in the middle between having no correlation at all, the 0 value, and between having a negative correlation, the -100 value. I would stay clear of these kind of weak correlations. So ideally, all the orange values are not interesting for us. And if we had any yellow or green cells, which represent the values closer to 0, they won't be interesting for us as well. You'll also notice the diagonal values are missing because they represent the correlation of the asset with itself. So they are omitted for simplicity. Now, if you look at the British pound's correlation to the euro, you'll find a value of +87. So these 2 assets are positively correlated, and we can take similar positions on these 2 assets at the same time. That was the merit of my British pound trade that I will discuss next. But beware. This is not the case throughout the entire year. These values can change from time to time, but typically they tend to hover around these ratios. How to use the matrix in trading. Okay, before diving to the supply and demand portion, there are 4 important rules that I always follow when I consider taking correlated trades. These mitigate a lot of the risks that comes as a package with this style of trade. Rule number 1. Correlated trades are part of the risk management calculations of the original trade. If you just bought a trading challenge and you're planning to take my advice and risk only 2% per trade, and you prepared a correlated trade to enter in the challenge, well then, for the original trade, you should only risk 1%, and the correlated trade another 1%. So the total risk stays at 2%. This is because both positions are moving in the same direction. If you risk 2% per position, you might end up getting stopped out at 4%, and suddenly your challenge is down 50% in a couple of days. Correlated positions can get amplified really quickly, so deal with caution. Rule number 2, correlation doesn't always mean better profits. Okay, so why do we take correlated trades anyway? Why not stick with 2% per trade and get it over with? The reason is actually very simple, because we don't know. Yes, we can never predict with great accuracy which one of these 2 trades will end up generating more TP. There are a lot of factors that go into the selection of TP zones. The biggest one being supply and demand, but there are other things to consider as well. For example, you want to aim for trades that reach your TP quicker. Well, you can never predict which one will be quicker, but using correlation will give you a higher chance of doing that, because one of them might move in a more volatile manner and be done in less than a week. The other one might take a week and a half. You end up making more profit on the first trade because you paid more swap on the second. However, this is a double-edged sword. You need to be at peace with the idea that sometimes separating your risk on 2 trades means leaving a little bit of profit on the table. But there's another big upside. You'll be protected from the market noise, which takes us to the next point. Rule number 3. Correlation does not imply causation. While 2 assets may move together, this does not mean one causes the movement of the other. Correlations are dynamic and can shift due to market news, geopolitical factors, or economic data. So for example, having 2 correlated trades on the euro and pound, and at the same time a news event comes up, like the unemployment rate in Europe, for example, and it's just hurting the euro position badly. The pound position would be safe. Rule number 4. Do not hedge correlated trades. Using correlated pairs for hedging strategies is just something that I don't do, and I don't recommend doing it. Hedging is offsetting the losses by opening a position in the opposite direction. For example, if you're long the pound, you might think shorting the Aussie at the same time will help offset potential losses. After all, they have a correlation of 87. Or go long on the yen because it's minus 86 correlated. This only tells me that there was something wrong in the fundamental analysis to begin with. It's either up or down, not both. If you go both, you'll never make any serious money from trading. So in the previous example, if you're following the fundamentals, you should go long the pound, long the Aussie dollar, and short the yen at the same time. Alright, now we get to the best part. How to make a very successful trade happen with mostly supply and demand analysis. Alright, so let's go straight into the British pound trade analysis. And this analysis, please listen carefully, because it ties into all supply and demand lessons that I taught you so far on this channel. And also I want to quickly touch on the correlations here, British pound and euro. And this is a trade that I took as well here on the euro, that rally-based drop, very, very high quality daily supply zone. So we are simulating, I removed the candles obviously here, we are simulating that today is the 18th of September 2024. And on that chart on the British pound, we are doing the same thing, 18th of November 2024. And here the euro came into supply just a couple of days later, and I can show you that when we are now getting the candles ready, we're just adding maybe one whole month. And you see, that is what happened on the euro. It came in that supply zone. Now, on the British pound, one of the most important supply and demand rules that I taught you is big brother, small brother principle. So I'm going now to the monthly chart and do the top-down analysis with you guys. Now we do full screen so I can clearly show you everything very nice. So the British pound is coming as we speak into a very high quality, look at this rally, base, drop, very high quality, strong supply zone. Nice leg out, very explosive, 2 explosive candles, consecutive candles, very nice leg out, strong move away from the zone, nice base. So we are actually arriving in a very strong monthly supply zone. Now we are going into the weekly chart, and surprise, surprise, we are moving into a weekly supply zone as well. And by the way, this is something that I'm going to teach you now. I think I have not taught this before on that channel. You see this part here, that's also zone, but that is called a wick over wick. You see that wick here on the weekly chart is basically also the next candle, this small wick, so it's called a wick over wick. So if you see a wick over wick on the higher time frame, then you also know on the smaller time frame inside that wick over wick, there is a high quality smaller time frame zone hidden in that higher time frame wick over wick. So it's here also a zone. So you have that monthly supply zone, you have that weekly supply zone. If I go down now to the daily, surprise, surprise, look at this here. Now I just remove all the zones to, well, the monthly zone and the weekly wick over wick. I just remove it just to visualize it better to you. Otherwise it gets really confusing. Here we have a very strong also zone, drop, base, drop, nice accumulation of orders, and then we got a drop, and that drop, you see price never came back into that supply zone. Well, it came into the wider version, and we'll talk about this in a second, and then price dropped all the way, made new all-time lows on the British pound. So what you see basically, and I want to show you that here as well. So first of all, why is this a strong zone? Because it's covered by monthly, it's covered by weekly. So it's big brother, small brother, principles are met. Plus here you see one more thing, the profit margin. That zone, price never came back inside that zone in that preferred version, and price made a new all-time low. So very strong move away before price ever came back into the zone. Plus what I want to show you here is, I'm very excited to show you that actually, because it's a very important rule, that it hit here the wider version. It hit here the wider version and just barely penetrated that wider version, and then it dropped without coming back. So this will tell you, okay, there's a lot of pressure inside that zone because price never came very deep inside that zone. It only touched that wider version. Plus on top, that zone, that small touch caused price to drop all the way down to make new all-time lows. So that's why you would expect the next time it touches the zone, it would just go a little bit deeper, and then you would get another very strong move from that zone. So let's quickly do that. Let's highlight that zone, and that's exactly the zone that I was trading. Now we do the following time frame, and we pretend it's today, and look at this, what happened from that zone. Boom. It came very deep inside that zone. That's fine. Our protective stop is above that zone. And the rest is history, ladies and gentlemen. Thanks for watching this video. See you in the next one.